Hi, I'm going to explain you how trend trading works. First we'll start with some examples, then I'll explain the concept, and at last some commonly used indicators. So let's get into some examples. I brought you here the German share index ranging from the beginning of 2014 to mid 2015, so roughly 1.5 years. What we can see from here is if you look at it from a very long perspective, which is seen up to 1 year, that's called long-term trading. Above 1 year is called investing. And yes, so that a long period of time the market moves roughly sidewards because there are small movements, sure, but the general notion is that the up and down movements are more or less equal. This changes around here, where we can see a strong upwards movement, of course overshadowed by some small up and down movement, which happens all the time. This means that in this case we have a strong underlying trend which goes in a real direction. We can show it like this, where I have drawn a line from the lowest to the highest point just to illustrate the trend. Of course, you don't have to take the perspective of a very long-term trading. You can also try medium-term trading, which is from several days to several weeks. Then, of course, you have a lot more trends. For instance, this would be a trend here another one, sidewards notion, a big uptrend. And of course, if you use even smaller time frames like day trading or trading from several days, we have trends basically all the time, because then every up and down movement is a trend. So now let's get to some illustrations. I've drawn a sample price curve here. So in general you want to enter, and of course you have an obvious trend here which goes from down here to up here. You usually want to enter a trend as soon as you detect it, so the trend has to have taken place. So in this case you would enter the trend in this area. If you want to enter the trend here, this is called counter trend trading, because you aren't following the trend, but you are predicting a change of trend. This is something a little bit different. Okay, then you enter it here. You're following the trend and you usually exit as soon as you detect that the trend has changed its direction, which is generally here. If you exit it here, it's similar to counter trend trading, but in trend trading it's usually also common to use some stricter exit indicators. Now let's get to some common indicators. The most well-known and the most often used indicators are the SMA, the simple moving average, and the EMA, the exponential moving average. The SMA, or simple moving average, is just the mean of the last n candles. I'll show you now a comparison of different SMAs. Here we have a comparison of different SMAs. They range from a bar period of 10 to a time frame of 200. As you can see, the darker ones are the ones with a smaller time frame, and they are closely tied to the price curve. And as bigger the time frame gets, the looser is this tie. So for instance, the blue one here is the SMA 200. It doesn't really react to the price curve very much. We have here some movement and it's just wandering around. So you use it to detect very long-term trends. Also notable is that usually in a downwards trend, the SMAs with a smaller time frame react stronger, so they are below the SMAs with a bigger time frame. This is reversed in upturn trends, so you have at some point a crossing of the different SMAs with different time frames. And these crossings are often used as entry and exit signals for trades. Now we get to the exponential moving average, or EMA. And the formula isn't that hard. You usually have your already intact average, and then you weight your New York candle with a strong factor. And this factor is usually dependent on the time frame you choose, so your parameter is the chosen time frame. So now I'll show you some examples. Here we have a comparison of EMAs of different time frames. They range from a time frame of 10 to a time frame of 200, and as you would expect, the EMAs with a smaller time frame are more closely tied to the price curve, and the EMAs with a bigger time frame are less closely tied. So generally the general behavior is the same as with the SMA. We can also compare an SMA and an EMA. In this case it's the SMA 50 and the EMA 50, and as you can see, the EMA reacts a little bit better to the price than the SMA. This is because the EMA has an exponential smoothing. So when you want to trade, bear that in mind, that you usually use an EMA just because of this behavior, because the EMA has a faster adaptation to the price curve. So lastly, if you don't feel satisfied with EMA and the performance of SMA, of course there are some more advanced indicators which you can use for trend trading. A very common one is the MACD indicator. It uses different EMAs to generate a buy and sell signal. The RSI is a momentum indicator which measures the up and down movements of a certain asset. Then of course there's a broad family of algorithms which is called double exponential smoothing, and they are generally an extension of the EMA, which is a single exponential smoothing algorithm, and they provide usually better performance because they can model the trending behavior of a price curve better. So these indicators are a little bit more complicated, so I will not explain them in this video. Well, that's it. Now we are at the end. Thank you for watching. I hope you enjoyed the video, and see you next time.